Wikipedia world. I am CA Radhika Singhal. So, we have discussed different techniques of capital budgeting. There's one DCF technique, IRR, which is still left. Today we are going to cover and discuss regarding IRR technique. So, IRR stands for internal rate of return. Internal rate of return is actually the rate of return which is earned by the project. So, every company has some cost of capital. IRR is used to compute that what actually return that project is giving you. That should be the cost of project. So IRR is used to decide the project, that is the decision criteria in IRR is if that IRR is more than the cost of project. And how IRR is computed? IRR is the relationship between P.V.C.I and P.V.C.O. And it is at that point, that is its return, where P.V.C.I is equal to P.V.C.O. So we compute a rate at that rate, which is the direct discounting rate, at which that P.V.C.I is equal to P.V.C.O. So that rate is the IRR rate. If that IRR is more than the cost of the project is acceptable. And if you have many projects, higher the IRR will be preferred. So when you have a mutually exclusive, the project which has the highest IRR is preferred. In case of complementary projects, you will compute the cash outflows and inflows of all the projects and then compute the IRR. If that IRR is more than the cost of capital, you will accept all the project, otherwise you will reject all the proposals. In case of independent projects, the project which has the highest IRR, or you can say the project which is having IRR more than the cost of capital will be accepted, others that is less than cost of capital will be rejected. This is how in IRR a decision has been taken. So to compute IRR, now it could be like cash inflows could be in one lump sum installment. So if the cash inflows are receivable in one lump sum installment, IRR could be computed as the PV factor of ₹1. So you will receive various tables in examination, and the table which shows the PV factor, which is that shows the value of ₹1 at different discount rate, or you can say at nth year. So if you are receiving, for example, an initial cash outflow is 1 lakh and after 5 years you will receive 1,50,000. So in this case, to compute IRR, you will simply divide 1 lakh divided by 1,50,000, which is initial cash outflow divided by the lump sum amount. Whatever the amount is, you will see that at which rate it falls under 5th year category. The rate at which it falls under 5 years. So you'll see that under 5 years where this value occurs, that will be the IRR of the project. So if you all have the PV factor of ₹1, you can open that table and you will solve this question. The initial cash outflow is 2 lakh rupees and the lump sum cash inflow at the end of 5th year is 4,20,000. So IRR will be 2 lakh divided by 4,20,000, which is 0.476. Now you all open the PV factor of ₹1 table and look at the end of the 5th year. So there is a row 1, 2, 3, 4, 5. Go in the 5th year row and see that at this 5 year, this 0.476 is corresponding to which rate. We'll see that when the rate is 16%, so when the rate is 16% and the year is 5, it is 0.476. So this 0.476 is actually the value of ₹1 when your discount rate is 16% and you will receive this ₹1 at the end of 5th year. So the present value will be 0.476. So the IRR of this project is 16%. So the next scenario is when cash outflow are in one go, but the receivables are in perpetuity. So in perpetuity means that forever you will receive an amount. You have to invest 1 lakh today and forever you will receive 20,000 every year. So in such scenario, IRR will be the annual cash inflow receivable at the end of each year in perpetuity divided by initial cash outflow. So let's say that take an example, an investment of ₹1 lakh will return ₹6,000 per year forever. So what is its IRR? So IRR will be 6,000 divided by 1 lakh, which is equal to 6%. So 6% is the IRR in this case. Now case 3, when the annual cash inflow are receivable for a finite life, 20,000 for 5 years. So how will you compute the IRR in this case? So first you have to compute the payback period by dividing the initial cash outflow by the annual cash inflow. And then you will look for this payback period in the cumulative PVF. So there is another table which shows the cumulative PVF of a rupee. And this PVP is equals to cumulative PVF at that nth year. So let's take an example that an investment of rupees 1 lakh today will return rupees 50,000 at the end of each next 3 years. What is its IRR? So we have to compute the payback period first. The payback period is equals to 1 lakh initial cash outflow divided by the inflow, which is 50,000. So this is equal to 2. Now you will look at table. So in our given books, it is table B, let's say. So table B is basically the cumulative PVF. So I'll look at the third year row, and in third year I'll see that at which rate it is equal to 2. Now the value of 2 does not exist at a particular rate. At 23% in the 5th year, the value is 2.011. And at 24%, the value is 1.9813. So in order to compute 2, I have to interpolate the values. So 23% it is 2.011. And to reach up to 24, the gap is between 24 and 23 is 1%. The gap between 2.01184 and 2 is 0.01184. And the gap between 2.011 to 1.983, that is, for 1% there is a gap of 0.0301. But you have to reach to the gap of 0.01184. So this will give you the IRR rate of 23.84%. Right. And now the most important question and also the last scenario for computing the IRR is when the cash inflow are of unequal amount and they are receivable against initial cash outflow for a finite life. So for this you have to compute. So in the last scenario, the cash inflows are of the same amount. In this, since the amount is not equal, you have to compute a fake payback period. In the same way as we computed in the last situation, which is equals to initial cash outflow divided by average cash inflows. So average cash inflow is basically the sum of all the cash inflows which are received divided by the number of years. So if you're receiving 50, 60, 20, 40 in 4 years, so you'll sum all those and divide by 4. You'll get an average cash inflow. How payback period is computed? Cash outflow divided by the average cash inflow, you will compute a fake payback period. Using that payback period, you will go back again to the cumulative PVF table and look where at that particular nth year where that fake PVP is located. So you'll get an idea that where this could be a probable IRR. Now using that IRR, you will compute NPV. So when NPV is equal to 0, there is the IRR of that project, because IRR is when your P.V.C.I is equal to P.V.C.O. That means your NPV is 0. So if that NPV is positive, you will take a higher discount rate and compute that what NPV is there at that 0 rate. And if that NPV is negative, you will take a lower discount rate and then compute the NPV. And then you interpolate the results to see that when NPV is equal to 0. Let's do one question. An investment of rupees 1 lakh will return rupees 1 lakh at the end of year 1, rupees 50,000 at the end of second year, rupees 10,000 at the end of year 3. So what will be its IRR? So first we have to compute a fake payback period, which is equals to 1 lakh divided by the average cash inflow, which is 1 lakh plus 50,000 plus 10,000 divided by 3. So you'll get a fake payback period of 1.875. Using this and going to the cumulative PVAF table, in the third year, you will find that when the rate is 28%, the value is nearby 1.875. So you will take NPV at 25%, but the value is positive here, which is 13,370. So you will take a higher NPV to compute till the rate when the NPV will be negative. So when you take rate as 42% and you compute NPV using 42% as a discount rate, you will find a net profit value of less minus 1,310 rupees. So when 28%, the net profit value is 13,375. When the rate is 42%, the NPV is minus 1,310. What will be the IRR rate when the NPV is 0? So when there is a gap of 14%, the NPV is negative. And the gap between 13,370 and minus 1310 is 14,680. But you have to reach a value where this value will be 0. So the distance between 0 to 13,370 is 13,370. So 14% will be added when the gap, you have to cover a gap of 14,680. Multiply by 13,370 will be a value or a rate when your NPV is 0, which comes out to be 40.75%. So this is a way on how you compute an IRR when the cash inflow are of unequal amounts for a finite life. So this is how IRR can be computed in different scenarios. There's one more analysis which is done, and it is called as sensitivity analysis. Sensitivity analysis is generally used to analyze that how much change in certain parameters, like say that if the selling price has been changed, how much it will affect the NPV, or you can say the IRR of the project. Let's take an example. In a project, the cash outflow is of 1,25,000 and the cash inflow is of 45,000, and the desired rate of return is 10%. So basis this data, you compute the NPV of the project. So NPV comes out to be 17,605. Now what does it indicate? If the value of any, let's say if the cost, that cost can rise to a level by 17,605, because at that point it is bearable for a company because the company still is in a profit mode. But when the cost will exceed 17,605, which is the NPV of the project, company will start incurring loss into that project. Similarly, if we compute the IRR for this thing, let's say that the IRR comes out to be somewhere around 14%. As of now, the cost of capital is 10%. So after the cost increased to 14% of the project, it is bearable for the company. But once it exceeds 14%, the project will become unfavorable, or you can say we start incurring the losses in that project. So using sensitivity analysis, we can actually identify that which areas are more critical and more focus areas where the emphasis should be laid on, so that the project does not get badly affected. So sensitivity analysis is a technique of evaluating the robustness of a project to its various variables. So besides all these techniques, there's one thing. If I ask you which measure is better, which technique is better, is it NPV or IRR? Let's say that you are earning 10,000 today, and after 1 year you start earning 20,000. Your dad is earning 1 lakh rupees today, and after 1 year 1,50,000. So the NPV of your dad is 50,000 and you are earning 20,000. So though the IRR is 100% for you and only 50% for your dad, but whose salary is better? Your dad's salary. So IRR cannot measure that what actually the absolute values are there in the project. So if you are investing a penny and it multiplies, you are investing 100 and it multiplies to 200. So though the IRR is 100%, but the NPV is just rupees 100. While in case if you invest rupees 1000 and multiply to 1200, so IRR will be less, it will be only 20%. But the NPV is 200. So because NPV is measuring the profit in absolute terms, NPV is a better measure than IRR, right? That's all we have to discuss in capital budgeting chapter. In case you have any query, please leave me a comment or let me know. I'll definitely try to resolve it as early as possible. Thank you. Have a nice day and keep smiling.